What's going on, guys? It's John DeYoung, and today I'm going to do a little bit of a different video. It's not going to be scripted, it's going to be pretty raw, and I'm just wanting to go over the January 2020 Corelogics report. Just want to sort of walk through my thoughts, what's going on in the market, my interpretations. I'm going to try and do these every month as the report comes out, and hopefully for other reports too that come out. I'm going to do them when I first look at them. So as I go through, you guys will see my reaction, what I'm thinking, what's going through my head, what's happening in the market, all that sort of stuff. But I have actually read this one beforehand, but that's what made me sort of trigger this new type of video. So let me know, give me some really good feedback on what you think of these types of videos and your impressions, and if you think I should continue to do these types of videos. But yeah, it's kind of, it's just gonna be raw, just gonna be what I think, my impressions. All of my other videos are either the podcast or, kind of a scripted video, which, takes a lot of time to put together and provides really good knowledge and information for you guys. But I kind of just want to have a sort of raw format as well and see what you guys prefer and what you think. So let's go through it. So yeah, as I said, this is the Corelogics Property Market Chart Pack. It's our insights, our story, January 2020. The first title really is Residential Real Estate Underpins Australians' Wealth. We've got residential real estate at 6.9 trillion, Australian superannuation at 2.9 trillion, Australian listed stocks at 2 trillion, commercial real estate at 1 trillion. And that really breaks down, that really shows you how significant the residential Australian market is. Like if residential real estate is nearly $7 trillion and the next best thing is superannuation at 3 trillion and Australian listed stocks at 2 trillion, it shows just how impactful that really is in the residential space. And they demonstrate it through this graph here, right? Where it's like, these 5 blocks are housing, and then you've got the rest of them here as well. So that's how big of the market share it really is. Down the bottom here, we've got 10.4 million number of dwellings, 1.81 trillion outstanding mortgage debt. So what that's saying is, obviously of this 6.9 trillion in real estate, not all of it is owned by the banks. Like, it's not all a mortgage. There's only 1.81 trillion worth of outstanding mortgage debt. So that's quite interesting. I mean, a lot of people, when they buy property, presume they're just getting a mortgage from the bank and then buying the property. But there's actually a lot of old wealth in residential property where like big players would own massive sums of residential real estate, but not actually have a mortgage for it. So that's really interesting to look at the comparison between those two. 51.5% of household wealth is held in housing. There's 421,111 total sales per annum and 254.4 billion in gross value sales per annum. So if you haven't watched my previous video on why the government won't let the housing market crash, go and watch that. I kind of explain what these numbers kind of mean and how they impact the market and what the government sort of does in that space. So it kind of breaks it down, makes a bit more sense to it. So go check that one out. Page 3 here, national dwelling values increased 4% over December quarter, which is the fastest growing quarterly rate since November 2009. So this graph on the left is the quarterly change in dwelling values, and it breaks it down by capital cities and the rest of state. So you can kind of see how significant this recovery or V-shaped bounce back has been. If you see, kind of December 2016, we sort of start to see this decline in the combined capitals, and then that goes all the way down to sort of I don't know what you say, May, June 2019, and then we had this rapid V shape back up, and that's a pretty significant bounce back and recovery. Even on the title, as they say, November 2009. So it's the fastest growing quarterly rate since November 2009. So, and that's like, this has happened in December 2015, as you can see here, and kind of happened slowly here with this recovery. But this is generally what does happen in the markets, is there's something that triggers and it rapidly bounced back. And for 2019, it was really a combination of things. It was that service reversibility changing from APRA, 3 interest rate cuts, which, if you think about how those interest rate cuts do happen, it's more significant every cut that they bring down, because say we're at 0.75 now, right? If that was to come down by 0.25, it's actually coming down 1/3 of what it currently is. So as it comes down 2.5 basis points each time, it's more and more compounding as it comes down. So that's why three rate cuts to 0.75 basis points now was pretty significant. And this is why we're sort of seeing this bounce back. So whether it's overshooting, I mean, consumer confidence and stock levels are really still kind of low. There's a couple of good things coming back on the market now, but it's going to be interesting to see if this is shot way too far forward, if it's going to keep going at that rate or sort of stabilize out or come down a little bit. I mean, as you can see up here, up the top, you can sort of see it to taper off a little bit. So that might be an indication that it's going to sort of stabilize or come back down as it's done over here. So yeah, it's going to be an interesting time. You've obviously got the full breakdowns here with the numbers over the quarter, but Melbourne and Sydney being the biggest 2 dominators in the market, obviously at about 6.2, 6.1% each. So yeah, pretty significant recovery. On page 4, we've got the national dwelling values were 2.3% higher over the year, with most regions experiencing positive annual growth. So annual change in dwelling values, again, we've got the capitals and rest of state combined. So we're higher over the year. So this is the annual change in dwelling price. Yeah, so sort of the same as the previous one. This is just quarterly, and this will be much more smoothly because it's annually. So we're still not at that sort of annual growth of this sort of rate up here where it kind of peaked sort of 2016 2017, but I think given this graph and how much data lags behind, we probably could see that in the next report. So annual change for Melbourne and Sydney's at 5.3% each. They're the biggest dominators. Interesting to see that Perth and Darwin are still being negative, so they could sort of be lagging behind and not really getting this upswing yet. They probably will, but they're not getting that massive upswing. Page 5. Nationally, the high end of the market shows the strongest performance, led by a pattern in Sydney as Melbourne. So what we kind of just saw with that dominant Sydney and Melbourne percentages skyrocketing back up. The annual dwelling value growth by percentile, Greater Capital City region, December 2019. So what this is kind of just showing us with the 25, 50 and 75th is that sort of those quartiles. So the bottom 25th, the middle, which is the 50th, and then the upper 75th. And what this is saying is, that the market segregates, and the high end market is obviously what fluctuates the most, right? Because like, if you buy a $500,000 property and it reduces by 10%, it's only going to reduce by 50 grand. Where if you buy $1 million property and it reduces by 10%, it's going to move by 100 grand. And so it's more, even though the percentages are the same, it's a much more significant amount of money, and that sort of increases and decreases at that much more significant amount of money as well. So that's why we sort of see this lead in the upper 75th quartile percentage, and that's where most of the price drive is coming from. And as we saw before in Darwin, it's sort of interesting to see that this has sort of stabilized out. I mean, it's evened out, which is counter to what I just said. But like that negative 7.5 from the bottom 25th percentile, that's very interesting. Maybe we're seeing there that, not saying that Perth people are slower, but they're taking more time to understand how the market's sort of recovering and back up. I mean, I'm not a big Perth market follower or Darwin market follower, so I wouldn't necessarily know, but from what I'm looking at here, it possibly could mean it's just taking a little bit more time for recovery, really. So page 6, dwelling values increased in 5 of 8 capital city markets over the past 12 months. So yeah, essentially what we were saying there, so the 5 markets that have increased are Sydney, Melbourne, it looks like Adelaide is still below, and Brisbane is just above. And then Hobart and ACT are above, and then Darwin is below. So where's the third? The third, so Darwin's below. Yeah, interesting. Sydney, Melbourne, Brisbane, Adelaide. There's only 7 here. Why would they say 8? they're showing 7 on the graph, and there's 8 capital cities. Interesting. So quarterly and annually changed dwelling values in Sydney. So we've got the Sydney dwelling values increased 1.7% in December. So that's kind of, that's interesting because it means it's kind of slowing down if we think about that quarter increased by 6.1% or 6.2% as it said on that sort of first page. December was only 1.7% of that. So that means the other 2 months in that quarter grew quite significantly. Dwelling values increased 6.2% in the quarter. Yep, which is what we just said. Sydney dwelling values are up 5.3% in the past year. Sydney dwelling values are up 5.3% in the past year. So even though we've had a massive downturn, the dwelling values are still up in the past year, which is really interesting. Sydney dwelling values are 6.4% less than the record high, which was July 2017. Okay, so we're still below the peak, which means there's plenty of room to grow, 6.4% to grow, and if it's going to overshoot that peak, it's going to be very interesting. Just depends what happens this year. If there's another interest rate cut, if APRA doesn't step in, then it probably does have the potential to continue growing past that point. But if APRA do intervene and try and sort of account for this housing affordability crisis we're having, yeah, it's going to be interesting, but we'll see what happens this year. Same again for Melbourne. So Melbourne dwellings increased by 1.4% in December. Dwelling values increased by 6.1% in the quarter. So same sort of thing here. Obviously that December month was slower than the previous 2 months. Melbourne dwelling values were up 5.3% in the past year, so same again, up regardless of the downturn that we had. Melbourne dwelling values are negative 2.3%, the record low, which was in November. Yeah, so interesting here. Melbourne's only 2.3% below the record high, where Sydney was 6.4% below. So yeah, Melbourne maybe doesn't have that much more room to grow unless it just continues with the city market and sort of overshoots that peak. But yeah, interesting there that, and the peak was in November 2017 for Melbourne. So technically that means Melbourne is a little bit behind Sydney. If Sydney's peak was July 2017 and Melbourne's was November 2017, could be a little bit slower. So maybe we could start to see those sort of trends follow from Sydney if Sydney market started to sort of correct or go back down or something like that. Might be an indication that Melbourne will do the same, just a little bit lagged behind. Now onto Brisbane. Dwelling values increased by 0.7% in December, so yeah, a bit of a slower one there too. 2.4% over the quarter, so that's more of still a little bit slower in that December month, but not as heavy as an impact. Brisbane dwellings are up 0.3% in the past year, so we're start to seeing a bit of that recovery. Brisbane dwellings are 0.1 below the record high, which was April 2018. So yeah, not a big Brisbane mark and guy. So don't really know what's happening over there, but that's an interesting factor. So they're potentially going to go higher than that record high very soon, which will be interesting for that market. I know there's a whole lot of infrastructure happening over there. Pete Warden actually just did a video on the Brisbane market update for 2020, so go and watch that if you're interested in Brisbane. So it's going to be interesting to watch Brisbane over time. Same again for Adelaide. I don't know a whole lot about Adelaide, but dwelling values increased by 0.5% in December. Dwelling values increased 1.4% in the quarter. So yeah, pretty even there. So even December's had more growth than the previous 2 months. So potentially Adelaide sort of kicking a little bit further up now as well. Adelaide dwelling values are down 0.2% in the past year. So we're still seeing that sort of downturn having an impact, but obviously looking at this graph, it's going to start going up. And if you haven't noticed, this is the quarterly bars here, and the line graph is the annual change. So as you can see, this sort of quarterly growth go down and then come back up, and it's coming back up pretty significantly here. So yeah, hopefully that sort of trends and starts to go back up that further. Adelaide dwelling values are 0.2% below the record high, which was in December. Yeah, so still below the record high, but potentially gonna get there pretty soon. So it should be an interesting time. Perth, yeah, interesting Perth. It's been quite negative some time. I think that's because of the mining boom, obviously. Yeah, I don't actually know when the mining boom was. I'm not a big Perth guy either, but Perth dwelling values were unchanged in December. So they didn't change at all. Interesting. Dwelling values decreased 0.01 in the quarter. Perth dwelling values are down 6.8% in the past year. Perth dwelling values are 21.4% the record high, which was in June 2014. Very interesting. So it's obviously been a long period of a downturn for Perth. Looking at the chart though, this quarterly change seems to be getting better and better as the months go on, hopefully trending that sort of Sydney, Melbourne growth. But yeah, interesting times. I mean, hopefully this, for all my Perth investor guys out there, Damien Kaiser, I hope this comes sort of back up for you guys, and yeah, probably not a bad time to sort of get in if you're a counter-cyclical investor. Hobart now, yeah, so we sort of, this big sort of increase in Hobart in 2016, 2017, where everyone was just like buying Hobart. So it's interesting that, you know, we really haven't seen negative quarterly change. There's a couple of months here that's negative quarterly change, but nothing, you know, see, I mean, that's only 2 months, really, 2 months. Until before December 2014. So yeah, they really haven't taken a hit. Hobart dwelling prices have increased 0.2% in December. Dwelling values decreased 3.4% in the quarter. Hobart dwelling values are up by 3.9% in the past year. Wow. So yeah, so 2% in December and 3.4% in the quarter. So been a lot of growth, but then it's kind of, yeah, as you can see, it's kind of like stabilized or not stopped growing, but yeah, really sort of stabilized there, which is interesting. Hobart dwelling values are at a record high at December 2019. Oh, okay, interesting. Good to know. So Hobart's still at a record high and potentially looks like it could kind of grow back up to this December 2017. Actually, don't hold me accountable to that. I think, yeah, there's something else. I know people aren't pushing Hobart as much as they were beforehand, but yeah, be interesting to see what's going on there. If you guys know what's happening in Hobart, leave it down in the comment section below. Darwin values decreased 0.5% in December. Dwelling values decreased 1.4% in the quarter. So we're sort of seeing the growth kick back up now, even though the quarter is down, which we saw earlier. That's right. So Darwin values are down by negative 9.7% in the past year. Darwin dwelling values are 31.8% below the record high, which was May 2014. Gosh. Yeah, so they're having a pretty tough time. If you know, you invested in Darwin a couple of years ago, you're probably not in the best spot, but yeah, we're all in a property cycle, so just sit and hold, I think. Yeah, so interesting times. I don't really know too much about Darwin either, so if you guys know, again, leave it down in the comment section below. Quarterly and annual change in dwelling values, ACT. ACT dwelling values decreased 0.1% in December, so they increased by 2.3% in the quarter. So yeah, really seeing that sort of growth taper off in December there. Might be just because of the Christmas season, I'm not sure, but yeah, interesting. Dwelling values are up 3.1% in the past year, and dwelling values are at a record high in December 2019. So they're at a record high now, which is very interesting. Yeah, I think ACT is one of those things, you know, with the land tax and all that sort of complications. If they remove that, it would probably free up some investors to flood into the market, I think. So yeah, I know that's a problem over there, but you don't really watch the ACT market overly too much, and that must be the 8th one. But that's an increase, so who knows. Okay, since October, settled sales volumes have trended back above decade average. Monthly settled sales with 6 months moving average. So yeah, the decade average looks like, 38,000 sort of there of settled sales volumes. And this, what's the dark blue and blue? So that's obviously sort of seasonalized or moving average, 6 month moving average. There you go, that'll be it. So yeah, as you can see there's more sales being settled than the average. So you can sort of see that decrease where there was kind of stock, not a lot of stock coming on market, not a lot of sales being transacted, all that sort of stuff. And now we're sort of seeing it come above this average. How far it comes above is going to be quite interesting because, it's already sort of hitting that sort of peak there. And if it gets to sort of this level, will be interesting. But yeah, obviously, this is what I was looking at before, and what sort of interests me is when we're looking at Melbourne and Sydney settlements. Melbourne's only at 3%, where Sydney's at 12% in annual changes of settles. So a lot of settlements happening in Sydney, a lot of demand, a lot of transactions happening over there. Melbourne, not so much. Perth's up and Canberra's up. So very interesting there. Whether that has an impact, maybe Melbourne is lagging behind there and needs to catch up. I'm not sure, but we saw those price increases, so it's obviously not having that much of an impact. Strong population growth and slowdown in the construction has pushed rents slightly higher over the year to December. So the annual change in rental rates national, so the rental rates came down significantly in 2009. Gone back up and sort of tapered off and slowly came back to 17, where we had that sort of boom, and now they've come down again, and now they're coming back up again, sitting around 2%. So interesting. Annual change in rental rates. So rental rates are coming back up. I think the only problem with this, if construction is pushing those rents up, which means there's not enough supply coming back onto the market, which means there's more demand for rental properties unless owner occupiers are buying it, which means rental rates are coming up. But the only problem with that is housing prices are coming up. So as housing prices come up, rental rates sort of decrease because, these 12-month leases are locked in at, $400 or whatever, and then the price of the property increases to, $600,000 to $650,000. The rental rate comes down because that rental is the same amount, but your house is worth more. So that's interesting. Despite rising rent values, the rebound in property values continued to put downward pressure on rents over to, so this is what I was talking about, sorry, the gross rental yields. As you see, the pricing of property, as it increases, the rental yield comes down because rents are still at that same value for 12 months or whatever, and then but property prices are going up, so you're yielding, you're getting less of a return. Seems pretty straight, seems pretty average over the states here, sitting around 3 to 5% sort of generally. I don't know what the average would be there, but Sydney and Melbourne obviously having lower rental yields because their housing prices are significantly higher. So the cost of renting is sort of maintained throughout all the states. I mean, obviously Melbourne and Sydney are higher rentals, but the price of property has obviously overtaken that, meaning their rental yield comes down lower. Days on market have tightened drastically over the year as demand improves. Median days on market has tightened drastically over the year as demand improves. So days on market is obviously coming down, which is just how long a listing sits on the market for. And this is, again, regionals versus capital. So you can sort of see in that market crash, as you say, we sort of saw this days on market increase to nearly 50, 60 sort of days there. So listings were sitting on the market for much longer because no one was buying property, and now you can see it come down as people are sort of snapping up these properties as quickly as they can. These days on market is sort of coming down significantly, so it's going to be interesting to see how far that comes down. Looks like the average, that line, sort of bottom line, sits at 30 days, which is generally how long an auction campaign is for anyway. So that's probably anything below 30 days would be pretty good. Obviously, private treaty could happen in 2 days or whatever, but yeah, if we're talking auction campaigns, it's at least a 5-week process, so 30 days or so. So yeah, it looks like we're now just above 30, so looking pretty good really. Means properties are being bought quite quickly. Interesting. Vendor discounting may stabilize as more stock comes on the market. So yeah, vendor discounting is basically how much a vendor or a person that owns a property currently is happy to discount their property by just to get the sale done. So I'm not actually sure how they calculate that. I should actually do some research into it, but I presume that, you know, they'd look at something like the median value of a suburb, average, mean, and then I said median, average, and mean in the same sentence then, one of them, and then sort of see how much, you know, a typical house of the same sort of caliber would sell for, and then how much that's been discounted by or reduced by to sell. But yeah, every house is unique, so it's going to be interesting to dig into how they actually calculate that number. So vendor discounting is increasing, which means, you know, that at the bottom of the market they were decreasing the properties by -6% just to try and get their house sold, whereas we're now returning to sort of this -4% mark, which seems to be sort of that level there. So obviously consumer confidence is back. Yeah, that's actually really high when you look at it like that. December 2016 being that peak there, and we're almost there. So consumer confidence is well back, and people aren't discounting their properties as much. New listings have fallen 10.8% over the year, while total listings are down 7.7%. The decline in stock for sale may continue to ease as sellers return to the market amid the price swings. Yeah, so basically we're still seeing really low stock on the market. I mean, negative 10.8% over the year is quite interesting because this time last year we were sort of seeing that decline pretty heavily too. So 10.8% over the year. We're down 10% of stock on market, so we're still very short, which means, you know, all this demand that's now coming in from the first home owners grant, or the first home loan deposit scheme, not the first home owners grant. All of I don't think there's been a lot of investor interest into the market, but they will start to come through. But yeah, I'm pretty sure all of this new interest is now back into the market, and there's plenty of demand, but there's still limited amount of stock. So that's why we're seeing these values kind of V-shape straight back up, because all of this demand is driving those pricing properties up. So it's going to be interesting. Number of new and total properties advertised for sale 28 days to December. So change in annual listings. Yeah, so negative 15 in Melbourne and -9 in Sydney. Very interesting. Some big numbers down here too. So very interesting. What else have we got? 2019 finished with a clearance rate of 69.5%, which is 28.4% percentage points higher than the same week in the previous year. Wow, nearly 30% higher than the same week in the previous year. Yeah, so as you can see here, December 2018 was obviously the bottom of those clearance rates, and it's nearly 30% higher in December 2019. So yeah, sitting at about number of auctions, that's obviously per week. Number of auctions is coming up to nearly 3,000, and we're seeing really high clearance rates. So this is stock coming back onto the market, and then we're seeing some really high clearance rates there. So obviously people are just smashing these auctions, trying to pick up property. It's going to be interesting to watch when we see sort of early January, February 2020 numbers come in with it's only 10,000 for the first home owner scheme, so it's not going to have much, you know, a massive impact, but the investors coming back in will be interesting. Housing demand. Population growth was 1.5% in the year to June, which sits just below the decade average of 1.6. So we're sort of on par with population growth. Total population change is sort of averaging out there, you know, sitting at 95,000 to 90,000 since 2004. So that's pretty interesting to see. Yeah, and this is what is interesting, this sort of natural increase. We're obviously having less children these days. or more people are dying, one of the two. And the net overseas migration is sort of stabilizing out. So yeah, it's going to be interesting. Population growth. I think population growth is one of those things that, like, you know, everyone puts such an emphasis on population growth, but you got to really be careful at what numbers you look at. So if you're looking at like a house and land estate, and population growth over the last 3 years has been significant, well, it's kind of a false presumption to presume that population growth means there's a much more demand for housing. It just means that there's more population or more people that are living in that area now because of all these new house and land estates that have been built. So population growth is good to monitor, but can be your worst enemy too if you're looking at some wrong numbers or make some false presumptions. Approved housing supply fell by 21.4% in trend terms over the last year, led by 31.2% decline in units. So number of dwellings approved for construction, national 3-month rolling. Yep, so houses versus units in construction approvals. So as you can see there, sort of 14, 15, 16, 17 even, housing and units were being approved at the same rate, and that was probably caused a bit of an oversupply of apartments. And now we can sort of see houses, you know, units are declining significantly, and that might be because you know, they say we've got an oversupply of apartments, but it's not going to be long before all of those old ones get snapped up. So it's going to be interesting to see what happens with those unit spaces, if that's going to increase back up to where houses was. But yeah, interesting time for houses versus units. I mean, land value is always the most important, and generally houses sit on more land size content, but land value is the key there. So if, you know, these units are being built in areas that have good value for their land, then maybe it's the new norm. Total annual change in investor housing credit shrank for the 3rd consecutive month in November. Yeah, so there's a big impact there, and I think that was APRA's impact. So this decrease from about 30% of mortgages on interest-only loans coming down to 13.9%. And it's not investors, that's mortgages originated on interest-only terms. Yeah, so people are paying principal and interest now, which is much more interesting. Maybe that's because principal and interest rates are lower. People feel more comfortable with paying down their mortgage, but yeah, an interest-only account with an offset is the way that I go. So that's interesting. Annual change in credit growth. Yeah, okay, this is investor versus owner-occupier. So annual change in credit growth for investors is down, which is very interesting. So we sort of haven't seen that investor housing demand come back up. Owner occupiers has come back up a little bit. It's kind of pretty steady throughout that down period. It's just the investors that took a hit really. So it's going to be interesting to see when that sort of credit growth comes back up. Portion of loans settled greater than an 80% LVR, 23%. So yeah, if you don't have that's people who haven't had a 20% deposit. So 23.1% of people don't have a 20% deposit. Interesting. Monthly value of the new finance commitments. So owner versus investor, billions. Monthly value of new finance commitments. So this is obviously the new finance that's coming through on a monthly basis. Yeah, so as you can see, investors are still significantly coming down. Owner occupiers have really kicked back up in this recovery. So yeah, it's owner occupiers that are driving this recovery now. It's not investors, which is really interesting. Portion of new lending for investment housing, excluding refinances. So investor share of total new lending decade average. Yeah, so wow. Investors are down, what, 28%? Or they're only at 28% now compared to the decade average. That's ridiculous. So yeah, big shrink in investors. The value of lending to owner occupiers increased 2.2% in October 2019, while investor loans were 1.4% higher over the month. Investors continue to compromise a lower than average share of the mortgage demand. Yeah, so owner occupiers driving this one. First home buyers participation continues to trend upward as prices move through the bottom of the cycle. First home buyers as a portion of owner occupier finance commitments. Yeah, okay. So we're sort of averaging, 20, 30% there, 26% or something like that, it looks like. of the market is first home buyers. So obviously, not all of them, there are rent investors, but a majority of them should be owner occupiers, and that's probably where we're seeing a bit of an increase coming through there. So yeah, interesting. 26% of the market is first home buyers. The investor portion of total new mortgage lending is at a decade low in New South Wales and near decade low for Victoria. Yeah. So as we're seeing in these trends, investors are just not interested at the moment, and I don't know when that will be coming back up. If property prices keep rising at the rate they are now, how are investors going to get back in, or are we so sheep-minded that we want to get back in when consumer confidence is back in and try and get back up at the top? Really. Very interesting. I don't know. It'd be interesting to see if investors start to come back in when we hit the top again. But surely it should stabilize at some point. Can't grow this long for this quick. The average standard variable mortgage rate continued to track 4.8% in December, the lowest rates since at least the 1950s. So standard variable mortgage rates over time. Yeah. So this sort of follows that cash rate trend. Almost exactly. Obviously, the banks take a little bit more for profit when it decreases and pushes on the full increase when it increases, but yeah, kind of more of the same. So we're seeing 3.43% 3 years fixed for investors. That's huge, and what that's essentially saying is banks when you take a mortgage, when you take a fixed year loan with the bank, you're actually, it's like going to the casino. You're gambling with them. So essentially they're betting with you that the interest rates are going to continue to come down so that they can earn more from your fixed interest repayment. And you're betting with them saying, oh, you don't think it's going to come down. You think it's just going to stay at there. And people don't really look at it that way, because they're kind of like, oh, let's just lock it in so I know what my repayments are going to be every month. There's not going to be any fluctuations or anything like that. But I read somewhere there was a study that it doesn't really matter if you fix or variable. It pretty much evens out over that 30-year period anyway. So historically, yeah, so that's interesting. So banks want to bet on you that interest rate's going to come down. If that's not telling you what their sort of chief economists are thinking, then yeah, hold on to that one. Investor mortgage rate premium. Investor mortgage rate premium. Oh, okay, so this is just how much more investors are paying for a loan. So it looks like about 0.6% there premium that we're paying as investors. And that's it. So thanks for watching, guys. Obviously, nothing that I've said in this video constitutes any personal, financial, legal, taxation, anything, advice ever. This is just all my opinions and my interpretation on what the graph means and what the market's doing. So if you're looking for advice, please seek out someone who can give you that advice. I'm not a professional, and so seek out a professional. Yeah, let me know what you think about the video, guys. I love sort of talking about this and understanding why me talking about it makes clearer in my head, and discussing it with you guys, so you guys get a bit of an understanding of how I'm thinking and what I think the market's doing at the moment. So yeah, if you're loving this content, make sure you subscribe. As I said, I'm going to be trying to do these on different types of reports as well. I want to be doing this every month as it comes out. So let me know how you feel about them, what you're thinking, what I can improve, what I can't improve. Is it too long? Is it too short? Do you want to go into more detail? All that sort of good stuff. So yeah, let me know. Thanks for watching, guys, and don't forget to subscribe, hit that notification button so you don't miss a video. And until next time, happy house hunting.